Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And today in episode 42, once again, we're going back to the basics, intermediate edition, conversation with Credit Union Cowboy, part 2. We're going to pick up from where we left off on our last regular episode in part 1. So if you haven't checked that out, we would strongly encourage you to do that before listening to today's show because it will probably make a lot more sense. Before we get into the show, as always, a couple of shout-outs and announcements. First of all, we are up to 31 countries now with the show. We have, and I could be butchering this again, but hopefully not, we have Yemen, which I looked up is in Western Asia. And then we have Ghana, which is in West Africa. So thank you to our new listeners out in Yemen and Ghana. Also, want to give a very, very special shout-out to 3 new subscribers. So if you haven't checked out the RU Premium episode, please go back and do that. We recently launched sort of a premium subscription or premium membership, if you will, to the Real Talk Personal Finance podcast and community. And I want to give a very special shout out to our 3 newest subscribers. We have Craig M, we have Diane D, and we have Cameron C. So thank you very much for becoming new premium subscribers to the show. We really think that you'll enjoy it, and we're happy to have you join us. Last announcement before we get into today's episode. If you didn't catch it on the last one, we also now have some merch available. So if you check the show notes for any of the podcast episodes, there should be a link to click on to get some merch if you'd like to support the Real Talk Personal Finance show. I know personally I've been ordering a lot of samples myself, and I really happen to like the mug. It's an 11-ounce coffee mug. Prints really clean on there, so I've been drinking a lot of coffee these days out of that thing. And also, some of the logos, since we went back and redid the transparent logo, I really like. We have an all-white logo, an all-black logo, and then, of course, we have the multicolored one that's on the white shirt. But the all-black logo is pretty sharp. I got it myself on one of our blue shirts. So if you do check out the merch, feel free to click on that. And there's also a variety for different colors. I had a friend recently say something about, well, why are the onesies that you have on there only in pink? And I said, no, they're also in blue. You just have to click the other tab and you'll be able to see the different colors. So make sure to check that out. There is a promo code in there for 10% off. That code is RTPF for Real Talk Personal Finance 10. RTPF10. Save yourself 10% on some merch. Premium subscribers, as you guys know, because we email you separately, you have your own promo code where you guys save 25% off merch right now is the deal we have going on. All right, without further ado, let's get into the show today. Please welcome back, I believe for the 3rd time, Credit Union Cowboy.
Hey, Cash Flow King. Good to be back. Thanks for having me.
You're welcome. This is right up your alley. This is your expertise. The listeners seem to enjoy the shows that we've done together. So we'll basically pick up sort of where we left off from last time, and we're going to talk mostly today about tax-advantaged accounts that might help with health and healthcare-related expenses. So I'm going to turn it over to you to get us started.
Yeah, I appreciate it. Tying back a little bit to what we talked about before, right? We were talking about different types of plans and high-deductible health plans. So I think probably most people are familiar with HSAs that you're eligible for if you're in a high-deductible health plan. So just to lay that out, in 2023, it's considered a high-deductible health plan or an HDHP if the deductible has to be at least $1,500, or for a family, has to be $3,000. That's up just a little bit from 2022. I think it was $1,400 to $2,800. So, HSAs is something that tends to be paired and offered with those. There's also flexible spending accounts. And then for non-HDHP plans, you may have a FSA option. You may also have something called an HRA or a PCA. These, generally speaking, have no input from the individual. They are just kind of gifts, so to speak, from the employer to help, get the member to the deductible amount. So we won't touch on those because those don't have a ton of involvement from an individual perspective. But we can go ahead and jump in on the HSAs. So, like I said, the minimum deductible for an HSA this year is $1,500 for it to, or sorry, for an HDHP is $1,500 for it to be considered an HDHP, to be eligible to have an HSA. The HSA limits, are a little higher than that. So for an individual, you can contribute $3,850 to an HSA. That is the max for 2023. Obviously, more than the deductible, and gets you, hopefully well towards your maximum out of pocket that you have on your HDHP. I want to talk through this a little bit. It maybe from your perspective, from a financial perspective, we want to talk about just how the pre-tax part works first, just to make sure that we clear up any misconceptions on how the HSA contributions are done.
Yeah, good point. And I think the very first episode, for those that are new to the podcast, if you go all the way back to episode 1, and of course the numbers we had at that time, I believe, were at least a year old, because we've been doing this for just over a year now. I think we go into it in excruciating detail, but it's important to do that, I think, again here, because it's been so long. So you'll often hear HSAs referred to as triple tax advantaged, and they are one of, if not my favorite type of account. There's a lot of things, which I don't know how much I want to get into this right now, that certain people will tell you in terms of strategy on how to use them. Maybe we'll get into that later. But as far as the taxation and how that works, and this is probably a good time for me to interject our typical disclaimer that we don't give any tax, legal, or financial advice on the show. Please always consult your own professional for your own individualized situation for advice. We are not giving advice. We are just giving ideas and information and education and entertainment, hopefully. So anyway, how it works is that the reason when they talk about triple tax advantage, the first part of that is, how does the money get into the HSA? And for those that are employees, like a W-2, and you have your health insurance through your workplace, if you have, as we've talked about, a high deductible plan, you can typically pair that with an HSA, and that's what Credit Union Cowboy was just talking about. When you put money in, most of you, hopefully and preferably, will be doing that through payroll deduction, right? And the reason that that's important is that you're saving money on taxes as the money goes into the HSA, not only for things like federal and state, but also, and this isn't always true for all pre-tax deductions, so it's a very important distinction, you're saving FICA tax, payroll tax. So there's a portion, typically 1.45%, that goes to Medicare that's uncapped, that you're not going to be paying on your HSA contributions. There's also a 6.2% OASDI, which is basically Social Security payroll tax, that you're not going to be paying on your HSA contributions. And normally you pay that up to a cap, which I think we've talked about in previous episodes, called the taxable wage base. But the point is, you don't have to worry about any of that shit with an HSA if you're making the contribution through payroll, because you're not paying that FICA or payroll tax on those contributions, in addition to not paying federal tax, state tax, and so on. So it truly is getting the money into an account like this as tax efficiently as possible. So that's sort of phase 1. And then, do you want me to go to phase 2 and 3, or do you want to stop there and talk about that?
Well, just touch briefly on, maybe what down the road, what can happen with an HSA, just because, again, I think that's important if we're going to talk about how to utilize an HSA.
Okay. So once the money goes in, typically there's a certain threshold. Every plan's going to be a little bit different in terms of how much cash you have to have in the account before you can start to invest those funds if you want to. It's possible that not all providers are going to have this option, but more and more we see this option become available. Some of them might say, hey, you have to have $1,000 or $2,000 or some nominal amount in there before you can start to invest a portion of the funds. And I think I've talked about this on a previous show, but I personally am fairly conservative with my allocation within my HSA, which is unlike the rest of the things I do, because I'm pretty aggressive across all my other shit. But the way I look at it is, this is money that is going to be used at some point in time, and more than likely there's at least a portion of the money that's going to be used each and every year. And there are people that will disagree with me. We can talk about strategy later, but I know that there's typically going to be a portion that's going to be used, and therefore I keep a fairly large cash buffer in that account. In other words, I will let the funds build up and accumulate in cash as cash until a certain threshold before investing it. So for example, if the HSA provider says, hey, you can't invest any of the funds inside of your HSA until you have at least $2,000 in there. $2,000, in my personal opinion, is not enough to have in cash. So I will personally have it accumulate far beyond that before I invest the excess or before I invest the difference. But that kind of leads into phase two, where you can generally invest the funds inside of your HSA, because it's possible, and hopefully you're not going to use all of the funds every single year. There's going to be at least a portion, hopefully the majority of your account, that you're not going to use every single year, that you're going to want to potentially use in the future, and you're hopefully going to want that money to grow over a long period of time. So instead of leaving it in as cash, especially in today's inflationary environment, and having the value essentially get eroded away, you might want to choose to invest the funds inside of that account. And the main benefit to investing funds inside of an HSA is that all of the growth, all of the earnings, interest, dividends, all that good stuff is also tax-free. You're not going to get a tax bill on that. So if you're investing the funds going into Section 2, Section 1 was triple tax advantage. Step 1 is it's pre-tax going in, or tax-free essentially going in. The growth, if you're fortunate enough to experience growth in the account, and over a long period of time you generally will, is also tax-deferred / tax-free, assuming you get to Step 3 and use it correctly. So that's also the case. And then finally, on the back end, in sort of part 3 or phase 3, if you take a distribution for qualified medical expenses, right? And I actually printed out a list of some interesting things there that you can use it for. But as long as you're using the funds for the right purpose, when you take the funds out of the account, you also get those funds out. That distribution is tax-free. So it's tax-free going in, Step 1. Tax-free while it grows if the money's invested, Step 2, and tax-free when it comes out if you're using it for qualified medical expenses, Step 3. So I'll pause there. There's a little more to it, but is that kind of along the lines of what you were wanting me to talk about?
Yeah, I think again that's important to just kind of rehash that a little bit. Like I said, been a little while since the first episode there. I also think there are ways at later, if you're later in life, you can do a one-time rollover of an HSA. I don't know if you want to touch on that or not.
Yeah, you can. I mean, it's very limited. I think it's a few $1,000s. I actually know. I'm going to call him out here. He wouldn't give a shit if I did. He's going to listen to this anyway. But I'm pretty sure Cube Crusher did this with, I think, are you talking about traditional IRA to HSA?
Well, I was talking about out of the HSA when you reach a certain age.
Oh, I see. Okay. All right. Well, there is a fancy little thing. I don't have it up in front of me, but it's a very nominal amount that you can do a one-time rollover into an HSA from certain types of accounts. And I believe a traditional IRA is one of those accounts where you can put money or roll money in, but that's a one-time, lifetime type of thing. I thought that's where you were going. As far as when you get a little bit older, yeah. So essentially and effectively, the HSA can turn into what a lot of people will term as a traditional IRA at a particular age, where the money still went in tax-free in Step 1. The money still grew essentially tax-deferred, if you will, in Step 2. But in Step 3, if you take it out because you just want to take money out and blow it, go on vacation, do whatever, that you would simply pay taxes. So it functions very similarly to a deductible traditional IRA as far as that goes. I'm not sure if that's what you were talking about. In my opinion, that's not a good use for the funds. There are people that do that, but I would make the argument that everybody, whether it's them as an individual or their dependents, they're going to have some healthcare shit that happens, and those expenses have to get paid for, and there's no better way to pay for them than tax-free. So I think that's a horrible use of the funds, but it is technically possible. Is that what you were going for?
It is, and I think it's worth noting. I don't disagree with your stance on it, but everybody has their own opinions, right? So I think that it's important to know, based, on where I'm going to start this conversation in a minute, that I think some folks may be concerned about, well, if I put money in, what if it's more than I use, whatever, right? What's going to happen to that?
Gotcha. Okay.
So I think that's important. So let's start with a distinction here between the HSAs and the FSAs, for example. A flexible spending account, an FSA, those are going to be, what they're called use it or lose it, right? So you'll identify an amount, typically you can identify an amount, through your employer that you're going to put into an FSA. Pretty sure, I think it's 3,050 for this year. So, you can put in up to that amount. All of that is available day one. So let's say your plan year starts January 1st, right? Most medical plans run 1/1. So if you're planning your start January 1st and you have mass, you go to the hospital or have to have surgery or something on the second, you have that full amount, whatever you've, allocated for the year, that's available up front. Okay. So you can spend that all at once if you need to. If you hit your deductible or whatever, you can spend that right then. It's still only going to be deducted across your paychecks, right, for the year. So you haven't even contributed that much yet, but it's all available to you. That is something that is, again, a consideration to have because everybody's in a different spot financially, particularly if you're starting out with an HSA. That'd be different. The HSA funds are only available once you've contributed to it. So you may get a little bit of seed money from your employer based on, pay range or if biometric screening, right, whatever it is. You may get a little bit there, but otherwise the money's only going to come as you put it in each paycheck, or if you did a lump part. But generally speaking, it's going to be spread out across your paychecks. So that FSA is available up front. Now, there's some good things about the FSA there. One, if you do that and you spend it on January 2nd, and then voluntarily or involuntarily you leave at the end of January, well, you only paid a couple payments towards that FSA, right? And you got to use the full amount. So that is something that's nice. That's not going to be recouped from you, right? That's part of it. And I should probably pause here and say that FSAs can be limited. They're very much employer driven, and in how they're offered and what they cover is going to be dependent upon your plan and the other, whether or not you're on a high deductible and are eligible for an HSA or not. There's all types of limits. They could be dental and vision only. So, educate yourself, right? Read through the material that they that they provide to you. Make sure you understand exactly what your FSA, could or would cover. But again, that's kind of the nice part about FSAs. Now, the downside would be, okay, you put in that $3,000 and let's say you have a really great healthy year. I mean, that's awesome. That's terrific. At the end of the year, if you haven't spent the FSA money, you you don't, that's it. You put the money in, it's gone. It's called use it or lose it, right? So if you only spent 1,000, right, of the 3,000 that you put in, you've just kind of kissed 2,000 goodbye, so to speak. So, and again, there are some limitations there. HSAs are friendlier for picking up a lot of different things that may or may not actually be covered by your health plan, but stuff like over-the-counter medicines, right? There are things that you can do with an HSA that you can't do with an FSA. So again, just kind of a base level on some differences between the two. But talking about that from an HSA perspective, again, it's 3,850 for an individual is the max contribution for 2023. I think there's a few things to look at when you're thinking about your HSA contributions. If you're going to an HDHP, particularly if you're going to it for the first time, it's worth noting again when we talked about the medical plans in the prior episode, we talked about looking at you know your history, right? What you can expect, what you think is based on the last 5 years or whatever, what you expect to spend medically. And I think you mentioned, if you were planning a surgery, right? If you're planning to have a child, whatever, right? Put that into your equation when you build it out so that you have a reasonable idea of what the expenses might look like. All things being equal, if you are in a good spot financially, you know, personally, if I was in a good spot financially, I have my savings where they need to be, I have all the other stuff where I need to be, I'm going to probably lean towards max funding the HSA myself. And the reason I say that is because, as you mentioned, right, it's triple tax advantage. That's one. Healthcare costs are going to go up over time, right? It's not getting cheaper to go to the doctor. And generally speaking, as you get older, you will incur more healthcare expenses. So it's because it's not an FSA where you use it or lose it, and it is a savings account, I think it needs to be looked at a little bit differently of, well, hopefully I don't use all that I put in, right, this year so that I can grow that base. And essentially it is what it is, right? It's a health savings account. That's why it's called that. It's an emergency fund essentially for healthcare if you can grow it to that point. Now, you may not be in a position to do that right away. Maybe the other savings that you have isn't, where it needs to be. Maybe you've got debt, whatever. But that is something to look at is that the HSA, because of the nature of the product, you need to look at it a little bit differently than you would look at an FSA. Does that make sense when we're saying that?
Yeah, I think so. And one thing I'll just add on the HSA part, it is kind of like an emergency savings vehicle for your medical expenses. However, and it's good to grow it over time. There's people out there that brag about like the 100K HSA. There's a lady that talks about that and all this shit. And that's fine. But at the end of the day, you don't want it to grow. We didn't touch on this in this episode yet. We did on the first one. You don't necessarily want it to grow too much, and I might be getting ahead of ourselves here, but if you do and you pass away and it goes to anybody other than your spouse, then it becomes taxable in the year that you pass away. Again, not tax advice, but something to be aware of. So it's a great tax-free vehicle, but it should primarily, in my opinion, and I feel very, very strongly about this, be utilized for you as the individual during your lifetime or expected lifetime or your dependents. It should not be looked at as a wealth transfer vehicle, because although folks can inherit the funds and it's treated differently than an FSA, from that standpoint, it is not something that you want to try to go out of your way to make as big as possible pass on, because it's not going to pass on tax free. And I think that's very, very important. There's a lot of people that disagree with me on that in the fire community, and that's fine. And we can come back to that if we need to. But I just wanted to add that. But yes, what you've said so far makes sense.
Yeah, and I don't disagree with that. I wouldn't use it as a vehicle to transfer wealth myself either. I just think that it's important, if you're in your 30s, right, looking down the road and again, putting into an HSA, it would be worth noting if, thinking about, again, your situation, think about your family, think about your parents, right? Is there a likelihood that you may have, that you may get to a point where you have diabetes, right? Or where you have different heart conditions, right? Whatever, high blood pressure, whatever you want to say, right? Thinking about it that way, planning ahead for that to have some when you start needing to pay for insulin, right? Or whatever.
Mm-hmm.
It's just a little bit that's where I go to. It's emergency savings fund for healthcare. But again, generally speaking, as you get older, of course, we know the cost overall of healthcare are going to go up, and the amount of healthcare you're going to utilize, right? Your utilization rate is going to, generally speaking, go up
Oh,
as you get older.
100%. Yeah. And
So,
yeah, not, and I don't want to like, shy away from that by any means. I mean, the average, retiree is going to spend hundreds of thousands of dollars in estimated out-of-pocket medical expenses. So it's absolutely important for that reason. But I think there's most people that are trying to build it up substantially aren't necessarily looking at that for themselves, but sometimes they get it twisted and look at it for somebody else. But yeah, no matter what, it's always good to have funds in there. Just make sure that you're using them yourself, whether that be in your older age in retirement or while you're younger or some combination thereof. Because the argument pretty much goes like, hey, if you can cash flow your expenses now, why would you reimburse yourself? Save the receipts. If you get in a bind, you have a receipt pile you can go back to essentially retroactively and take a tax-free distribution for those qualified medical expenses later, which is true. Personally, I think they're going to eliminate that quote-unquote loophole, if you want to call it that, because that's really not how it's intended. But yeah, it's always nice to build it up, to have a little bit extra to help to subsidize and pay for some of those expenses in your retirement. But yeah, just don't do it. Don't overdo it. But again, the limits are fairly nominal at the same time, right? You can't put the same amount of money every year in an HSA as you could a 401k plan, for example. And so, I think the risk of them getting quote unquote too large is somewhat minimized, partly as a function of the limits. But yeah, I think we're kind of sort of on the same page there. You're saying, if I'm reading between the lines right, it's okay to build it up because you're going to need it later when you get older and you're sicker and shit costs more. And I agree with that. But I'm saying do that, but don't do anything really more than that to the point where you're trying to pass on hundreds of thousands of dollars because they're not going to end up going tax-free to your heirs other than your spouse. Is that, we on the same
yeah,
page there? Okay.
yeah, absolutely. And I think that again, it's just an important, distinction, right, for it to look at it that way because again, it behaves differently. It's a different vehicle than an FSA. Or something where you may be, on an FSA, for example, you may be, when I've done them in the past, I mean, I'm really trying to dial into, okay, what is my first question is what does the FSA cover, right? What can I use it for? Okay, is it limited? Is it not? What are my options with it? And is it paired with like a PCA, a personal care account, one of those accounts that I mentioned when I wasn't on a high deductible plan that was offered by my employer? Okay, so I'm trying to get to a number, right? And whatever I've been spending, that's where I want to kind of be around that, but I don't want to really overshoot it with an FSA because that's just money I've just lost, right? Whereas
Hmm.
an HSA, again, to your point, you know, be mindful about it. I think, as you said, there's different opinions there. But if I'm looking at self only or even family, right, the maximum HSA contribution for a family is 7,750 for this year,
Yep.
right? So in 10 years, let's call it if they go up there a little bit, you could maybe get to where that's like 80,000 if you put in the max for a family for 10 years and didn't touch it. And I just, again, there you mentioned rollovers. There's other things you can do, yes, but you know, it'd be really, really hard to grow that, I think, without attempting to a level that would just be astronomical and something you couldn't touch. Because also during that 10 years, you're not going to have zero medical expenses. If you are, I would love to have your genes. That's awesome.
That's
You
right. No,
know,
you're right. And this is probably beyond the scope of our show, but just to throw this out there, because there's a lot of folks that talk about this, I don't think we've really talked much about this on the show before. But when I say invest inside of your HSA, generally speaking, I'm referring and alluding to your typical standard stock market marketable security type of stuff. For most people, it's going to be some sort of mutual fund, right? But there are other HSA providers out there, and for those that are so inclined, personally, I wouldn't, and I'm saying, as a financial services professional and also as just a person that has and uses an HSA, personally, I would not touch what I'm about to tell you with a 10-foot pole, but they're out there for those of you that want to go down this rabbit hole. There are self-directed accounts. Now, I'm not saying self-directed accounts are bad. There's different types of retirement accounts. You can do some self-directed stuff, and I've done that. But I'm talking about specifically for your HSA, there are certain types of investments that you can make that are outside of quote-unquote Wall Street, outside of the stock market, that some providers will facilitate and allow you to set up. They're not going to recommend things for you. They cannot recommend investments. They're simply going to be paperwork pushers and get things processed. But where I'm going with this is theoretically, right? It's possible that you invest in some non-Wall Street, non-stock market type of investment that's allowable through a self-directed provider that offers HSAs, and you hit a fucking grand slam and you quadruple your account because of some awesome investment. Is that likely to happen for the vast majority of people? No. And I think there's way too many potential landmines to step on when it comes to that stuff. And I would generally, we don't make any recommendations, but this is a recommendation to not go down that road. However, for those that are so inclined and you want to go down that rabbit hole, feel free to explore, but do so with extreme caution. But it is, yeah, anything's possible, right? You could have an astronomically large HSA due to some non-traditional investment that you knock it out of the park with. But to Credit Union's Cowboy's point, I think he's right. The vast majority of people, if they're investing their HSA money at all, if they're fortunate enough to accumulate a balance inside of there at all, are going to be doing it in fairly regular, quote unquote, normal stock market type of things, which are generally not going to quadruple your account overnight. And therefore, your overall balance over a period of time should be fairly modest. And hopefully, you don't have to worry about some of the things that I mentioned where you're just putting away or you have too much, quote unquote, in that account for the wrong reason. So, anyway, that's just a quick aside for those that are feeling adventurous today and want to go down that rabbit hole. Do so with caution, but it is possible. I just don't think it's probable for most, and I would not personally do it.
yeah, again, a lot of options, individualized for sure, but I think kind of laid out the case there a little bit for HSAs. And so what I would say is, for me personally, I'm gonna, overfund that HSA over my, projections of what I'm thinking I'm gonna have medical wise for the year. The extent to which you do that would be dependent upon what your current HSA balance is and all the other things that we talked about, right? But it doesn't it doesn't make sense if you have an HSA, if you're HSA eligible. I don't know of an argument to not pay every medical expense that not have it all covered, so to speak, by the HSA because again, it's tax-free money.
It
right?
is. Let me
That you're
interject
spending on
again
it.
here. Sorry, I know I keep interrupting you. I just can't help myself. I want to say a couple things. Number one, with all that said, and this might sound counterintuitive to what I was just talking about with accumulating the large balances, but generally speaking, if you can afford to do so for an HSA, not for an FSA, because it's a little different, as Credit Union Cowboy was describing to us, but I would absolutely, if you can, max fund an HSA every year. Because again, the limits are fairly modest. You're going to probably need the money at some point in the future. It's a great way to get, a tax break, not only again for federal and state, but also for the FICA taxes. You're more than likely going to use the money for something in the future, no matter what. That's the first thing I wanted to say. So max fund if you can. The second thing is there are people, and I've had people where I've talked to personally about this, and I'm glad we're doing this episode because they don't truly understand what that looks like. For example, I've heard somebody say to me one time, well, basically they didn't say it exactly in these words, but the gist of it was, I'm paycheck to paycheck. I can't afford any more deductions out of my check, so I can't put money into an account like that. And they had an HSA, and they can't put money into the HSA, but oh, by the way, they have some medical bills, and that's one of the reasons that they're paycheck to paycheck. And it's like, well, hang on a second. Let me walk you through what you're doing, right? You're essentially going to work, you're working, you're earning an income, you have all your other stuff that comes out of your check, but also you're going to go ahead and pay federal tax, FICA tax, state tax, local tax, and so on. And then from the peanuts that are left that hit your bank account, you're then going to turn around and take those funds and use that to pay for your medical expenses when you could have avoided all those taxes and simply directed that money into an HSA and then essentially paid for it out of the HSA completely tax-free. And finally, I got them to see the light, like the light bulb went off. But there's so many people that don't, they just see this as an extra thing. Oh, this is an expense. This is an extra place that I have to put money. This is something that I quote unquote can't afford. But if you dive a little bit deeper into it, you realize, well, holy shit, like I absolutely need to do this because it's going to save me X percent, fill in the blank based on your situation on taxes.
Right.
You know what I mean? And
Right.
it's crazy.
So let's talk about that a little bit because I think I've heard the same thing in working in the space. I've heard that, and it's let's talk real numbers, right? Just for examples here, but let's say you want to use the 22% tax rate,
Sure.
right? I mean, and that's not even all of the money. That's not even all the what comes out of your paycheck, right? Before you get it, right? That's not all of it. But let's just say 22%. How
Well,
much more do
that's
you have to
federal though.
make?
Hang on. So let's do this. So 22%, right? Estimated marginal federal, right? So your effective
Hmm.
rate's going to be lower, but fuck that for now. We're going to go with 22. 22 federal. Let's say you live in a state where there's no state tax. We're going to be really generous and put a zero there. And then on top of that, you're going to pay your 1.45% Medicare. You're going to pay your 6.2% employee portion of Social Security. So just from the 22% bracket plus your payroll tax, assuming you have zero for state and zero for local, we're being overly generous here, 29.65%. Call it 30% right there.
Yeah, yeah, and that's being taken out. So if you've got $1,000 in, again, and you can run these numbers, right? Like if it's $1,000 medical bill, if you can do that pre-tax, it costs you $1,000 that you made, right? If you let it go through all the different taxes and everything else that's like you said, you mentioned Medicare, all the stuff that's in there, how many more hours did you have to work to pay the same $1,000 medical bill?
Yeah, 1428 and change, basically.
Yeah, yeah, that's almost 1.5x, right? Like
Right.
that's fucking stupid. Don't do that. Like that. It doesn't make sense. And I hear that again. Well, I don't. And then it's well, but if it didn't happen, then it just wouldn't. Yeah, but healthcare, it's going to happen. You and I've talked about it. Hopefully, I want everybody to live a healthy life and see the doctors as little as possible, right? But the reality is, you're going to have to go at some point. Everybody's healthy until they're not, and then it's a little late when that big expense comes in. It's a little late to fund the HSA. Again, there's maximum contribution limits, right? You
That's
can't
right.
just do that
And
overnight.
and if you like, let's say you miss it for the year. So normally it runs, calendar year or whatever, right? And especially if you're doing it through work and through payroll and you're getting the FICA tax break, so you're not paying FICA tax. Well, now all of a sudden you get to January the following year. I believe you can still technically put in for the prior year, but for you to do that, guess what? You're going to have to write a check. And the funds that you're using to write that check that's money that you've already paid taxes on. You've already paid the FICA tax on that. You're not going to be able to get that back. So the point is, if you were having to write a check into your HSA as opposed to doing it directly through payroll, it's actually going to cost you a smidge more because, yes, you can deduct it on your taxes. Again, not tax advice, but you're not going to be able to go back and get that 7.65%, if I'm doing my math right, on the FICA portion. You're still going to end up paying that if you don't do it through payroll. So the point is, the takeaway is, if you're an employee and you work for an employer that allows you to put money in an HSA and you qualify and have the high deductible plan and all the shit we talked about, and you're going to make contributions, your best bet is to make contributions through payroll because you're going to get the maximum tax savings by doing it that way. Not advice, just facts.
Yeah, agreed. One thing that I do want to, I will kind of close out HSAs here, and this is something that actually you and I have talked about as well. Generally speaking, you're going to get a card, okay? Wherever you go, to the doctor or whatever, you can use the card and it pay for the bill when you're there, pay for the visit, whatever. Something you and I have talked about that I would encourage you, and this kind of ties into some of your other episodes about credit card hacks and that stuff. Generally speaking, it's pretty easy to set up once you've got your HSA set up. You can set up to, make distributions to yourself directly to your bank account. Now, this can be a little bit of, it's an extra step, right? If you use the card, okay, that's great. Use the HSA card at the doctor's office. Take the receipt. Can't stress this enough. Hold on to your receipts for HSA. Any purchase that you make, I'm just gonna do that. It's a good flag for the IRS to look at. So keep your HSA stuff. Again, it's very regulated what you can spend it on. So keep detailed receipts, EOBs, whatever. Keep that, file them just like you do your taxes for prior years. You can put them even with your tax returns from prior years. Just keep that information. But that said, what I like to do is, if you've got any sort of rewards, credit card, and you're not carrying a balance on it, right, or anything like that, I would encourage you to use. Some might even for like drugstores, for example. There's a lot of credit cards that offer, 4% cash back or, 4 times miles or, whatever if you use it at drugstores. So it's an easy thing to put your HSA card or your FSA card, whatever, on file, at the pharmacy,
Yeah, don't
right?
ever
And
do
do
that.
that. Yeah. So what I would say, and same thing at the doctor's office. I've had doctor's offices do it, and I was just like, nah, I don't want you to keep that card, right? That's not it. Don't want you to auto bill me for things because again, there's a lot that can happen in the medical space where the original bill is not always what winds up being agreed upon at the end of the day with insurance and whatnot. So, but that said, I would encourage you to use some card that puts you at an advantage for that and rack up the miles or the points or the cash back or whatever with that. And then just, I very simply, when I go in or when I pay a bill online, whatever, I'll pay it with, one of my other credit cards. And then I just immediately pull up on my phone and go to my HSA website, log in, and, you know, it's super easy, right? I just put in the date and the amount and have it send it to my general checking account, right? And then I still keep the receipts, right? Okay, this is what I did. This is why that, I reimbursed myself, but I'm getting, something back out of that medical bill and I'm still paying for it out of the HSA because that's where the funds are going right to my account. So again, a little bit of a hack there. Like I said, you and I have talked about that. I think it's a great,
Yeah, it's
thing to
huge.
do.
I got a spreadsheet I pulled up right now. I actually just for fun, I uploaded this to the portal for my CPA. Not that he necessarily needs this unless I get audited, but it's fantastic. Well, it's not fantastic how much money I spent, but in 2022, I spent or took out distributions of almost $6,400 out of my HSA. It was a bad year medically. I had a lot of shit going on. I had a lot of expenses, but if you think about that, that's a lot of credit card sign-up bonuses. That's a lot of points. And we did exactly what Credit Union Cowboy just described, which is using strategically different cards at different times for different reasons to get your points and then immediately reimbursing yourself from the HSA. I actually had a bill this morning, and I reimbursed myself through the HSA. I put it on our IHG card. I got 5 times points for that, and it's not costing me a dime. I'm paying for all of it tax-free, and it's fantastic. And one thing I'll say, I absolutely agree with everything he said. I have my own little system, right? So I'll print out whatever the receipt is, and if they don't give you one at the medical office or whatever, you can usually have them email you one, or if they mail you a statement in the mail for your bill or whatever, you have that. I have the HSA reimbursement, and so every provider is probably a little different, but the way mine works is they will send me an email when they go ahead and process the reimbursement. So I go in, just like Credit Union Cowboy, I say I want to reimburse myself. They send an email saying, this many funds on this such and such date is being sent to you. I print that out, I staple it to the actual receipt, bill, invoice, whatever you want to call it, and it goes in an accordion folder and it's filed for taxes. And when I'm putting it in there, my strong recommendation to everybody, if you have the ability to do this, there's usually a comments section. And I always put in a comment, where it was it a prescription? What prescription was it? Was it a refill? Was it, whatever it was, I'm putting it in there. I'm putting the date in there. Like if there's a provider you're seeing for a long period of time and they send you statements for different time periods, in parentheses, I'm putting this date to that date. So I know exactly what it is, and you're able to do it that way. And I just like Credit Union Cowboy, there's an app on my phone. This morning I happened to be at home, so I did it on the laptop and logged into the website. But no matter how you do it, that, in my opinion, is the way to do it. You are generally not getting any rewards for using an HSA card that's given to you. Not to say that you can't, but if you can pretty much accomplish effectively the same thing but get rewarded for it in the process, this is a great way to be able to do that. And I think we touched on this on other episodes. I'm probably beating a dead horse here, but it's something that I'm very passionate about, and I think everybody should do it if you can. You're right, it is an extra step, but as long as you're well organized, it's really not that big of a deal, and it doesn't take that much more time, and you can get a lot more rewards from doing that. So anyway, I'll stop.
Right. No, I mean, again, you think about it, you think about the numbers you're in. So we're talking about it's 1,000 versus almost 1,500, right? If you use an HSA. So obviously want to do that. And then you're talking about, $6,000, right, for yourself last year. I mean, a little over that, but $6,000, right, that you're getting benefits on.
Correct.
On top of it. I mean, so we're triple tax advantaged. We're getting our points or our miles or whatever they are. I think it's something to consider, that a lot of folks, they're somewhere in that process between either, I'll just pay it out of pocket, I don't need an HSA, I don't want to mess with that, which is, not the ideal stance, all the way through to, I'm already doing that stuff, and which is great. The one thing that I will again say is, I kind of mentioned it, but it's a caveat that I really think we need to throw out there. That aspect of using the cards to your benefit and reimbursing yourself only makes sense if they are cards that do not carry balances.
Correct.
Because then all you're doing, what you're going to pay in interest is, probably close to what you were losing, right? With it being, or what you're saving by it being a tax advantaged account.
100%. I had a premium subscriber, one of our new subscribers, right? And again, we appreciate everybody, and thank you to those that are subscribing to the show. One of the things I sent out is Cashflow King's favorites, and I actually have a document, and I will change this up periodically for something that I'm passionate about or I like and why I like it, and if I'm using it, which most of the time I am, why I'm using it, how I'm using it. And I sent out a document for a particular credit card as one of my favorites, Cashflow King's favorites. And they, wrote me back. They emailed the show, and basically they asked about what's the APR on that card. And I'm like, no. You need to listen to pretty much every show where we ever talk about this, because that is not how you're going to use this. Please don't apply for this card if you have to ask that question. Now, maybe it's just a genuine curiosity type of thing. Okay, fine. You want to know what it is. But they could tell you that the APR is whatever, 100%, and you shouldn't care, because you shouldn't be applying for it and you shouldn't be using it if you're going to have to carry a balance. And if you are, as we've talked about in previous shows, there's other strategies and ways to handle that, and maybe cards to look at. This was not a card for the APR. I'm almost never going to suggest or use a card because of the APR. I don't give a shit what it is. I'm using it for the benefits that the card has, for the points that it can deliver, and those sorts of things. And so that happened to be part of that document. But this, no matter how many times we say it, and that's why we probably sound like broken records, but this is a true story, like people need to hear this. Do not do credit card, travel, points, hacking, whatever you want to call it, if you're carrying a balance on the card. I don't care what I put on Cashflow King's favorites. If it's a credit card and you're worried about the APR, please do not apply. In fact, you might even want to unsubscribe from the show, and I hate to say that, but like that is not the intention.
No. We're here to help in a lot of different ways, right? And educate in other ways too.
All right.
But to your point,
stay subscribed to the show. Just don't get the fucking card, okay?
Don't leave. Cashflow King needs his coffees.
That's right.
But I do. Yes, that's something worth again mentioning. And maybe you're sitting there. I just want to say one thing to the folks that are again, if you're struggling to where, hey, I don't know how I can do that, or hey, maybe I've just started an HSA and I again, it's not built up yet, right? And I got a bill. I'm not sure how it works. You'd have to look through it. I haven't done it myself, but I know on a prior episode we talked about care credit, right? So if you're talking about that, I mean, if you use care credit, you get those 0% financing options and whatnot. I'm not positive on this, but I don't know of any reason, since it's used for a healthcare, only. I don't know of any reason you couldn't put it on that card for a time period and then reimburse yourself from the HSA, to make those payments.
Well, you might not even be able to do that, though. Like, you might not have to do that. You should be able to contact your medical provider directly. I've done this before just for shits and grins because they pissed me off. They sent me a bill for some stupid fucking amount, and I pretended I couldn't pay it. I went on a payment plan. I paid them over 12 months at 0%, and they can suck it, okay? So you should be able to contact your healthcare provider and basically say, hey, look, I need to go on a payment plan. And I'm sure it happens somehow. I don't know if there's laws against this. I'm not an attorney. This is not legal advice. But I would be very, very, very surprised if there was a healthcare provider that was going to charge you interest in terms of making direct payments to them. So, for example, they send you a bill, you owe $1,200, and you call them up and say, hey, I can't pay it. And they say, well, would you like to go on a payment plan? Can you pay $100 a month? Fuck yeah. And then you're paying $100 a month directly to the healthcare provider at 0%, presumably, right? And that's, I think, the strategy that you go. And then to your point, as you're building up the HSA simultaneously through your paycheck contributions, you're reimbursing yourself for that $100, and they can float the balance at 0%. I would try that before care credit. And if that's not an option, maybe you look at care credit or you look at something else. But most of the time, from my personal experience and from what I've heard from other people, most healthcare providers will, because they want the money, right? They're going to work with you and put you on some sort of a payment plan.
Yeah, and again, I just mentioned that because the structure may be different, right? I mean, so if it's if it was $1,200 and they say, can you pay $100 a month? Maybe that's doable to reimburse from your HSA over a 12-month period, right? What if it's $5,000? What if it's $10,000? Okay, what if we're getting to something that's not, maybe their terms are still like, hey, you got 12 months and care credit says, well, we'll give you 4 years, right?
Gotcha.
Whatever it is, I'm just saying, going back to that combo, do some research, see what your options are, right? Because there's a lot of ways you can help yourself. Medical bills are probably one of, if not the leading cause, right, of like bankruptcies in the country. I'm pretty sure that's right up there, right? So that's why this is a super important, thing to look at, and to try to plan ahead for, because generally speaking, you don't see those coming, right? And that's why we're talking about overfunding the HSA from a standpoint of not just what you're going to use, this year, what you think you're going to use. Again, different mindset from an FSA. Don't want to totally gloss over the FSAs, but worth funding. You mentioned something a minute ago, though, and this is a good little opportunity to talk about a lesser known account. You mentioned, the instance where somebody was saying, well, I can't afford to make the contribution, but oh, by the way, it's because I'm already paying the medical bill. Right. We know that childcare in the country is just astronomical expense, right? What again can be offered is something that's called FSA dependent care account. So this is for, again, it can be a child, I think up to age 13, or anybody that you claim as a dependent, like an adult with a disability, anything like that. You can that's covered by you. You use this for, and the limit, let's say if you're married filing jointly, and I think it's $5,000 for 2023 that you can put in. And again, this is pre-tax, right? That you're going to fund this FSA dependent care account and utilize that for dependent care. So going back, everybody with kids just about has some sort of dependent care, right, that they're paying for. Some don't, some have families, some, whatever, or can stay at home. But to an extent, you've got a lot of folks that are using some sort of care for their children. Basically, what an FSA dependent care account's doing is saying, how would you like the first $5,000 that you spend on that to be tax free? That's what it is. So, again, I know folks that are a little confused by that, including those that have children and they don't, they have that offering, but they don't really understand it. They're not sure, well, I got to deal with the reimbursing myself and blah. It's $5,000 that you can use for childcare that's tax free.
And going back to our example earlier where we used the 22% federal tax plus the FICA tax, and I believe, correct me if I'm wrong, I know for a fact the HSA avoids FICA. I believe the FSAs do as well. Is that your understanding?
I believe so, yes.
Okay. So if that's true, and again, assuming 0% for state and 0% for local, that $5,000 that Credit Union Cowboy is talking about that can go into a dependent care flexible spending account to be used for your children and their care, that's basically saving you $1,500 in taxes, right? If you're going off the 30% total tax for 22% federal plus the 7.65% FICA rounded up to 30%. If you're putting $5,000 into an account like this, then that's theoretically going to save you about 30% or about $1,500 in taxes. Another way to think about it would be, how much do you actually have to earn at work, pay the 30% taxes on that amount of money to end up with the same $5,000? The math changes a little bit. There's different ways to look at it. If you earn, say, about $7,142 at work and then paid the 30% taxes to end up with about $5,000 net, that's one way to do it. You have to work a lot more. You have to earn a lot more. The other way to do it is you just put the $5,000 into an account like this, which is going to reduce your income by $5,000. And if you're using that same 30% as an example threshold, that's saving you $1,500 in taxes, if that makes sense. That's another way to think about it.
Again, this is one of those where if you have any sort of child, and again, I want to clarify here, like, I'm looking at it right now, right? Care for your child who is under age 13, before and after school care, babysitting and nanny expenses, daycare, nursery school, and preschool, summer day camp. And then, or, care for your spouse or relative who, is physically or mentally incapable of self-care, right? And lives in your home and, again, is a dependent, right? But those are all the things, summer day camp, babysitting. I mean, the stuff that people are like, I don't know, I bet it doesn't cover that, or, what. It does. It does. And it's fucking stupid to not, take that. If that's you, if you're that person listening, I'm sorry. But it is, you need to take advantage of this. If you've got the extra dollars, and you just don't care, okay, well, whatever.
Buy some merch with it.
Yeah, buy some shit from the show, subscribe 12 times, right? Like this, I don't know many people that just want to throw away dollars that have this opportunity. So I would, again, encourage you, check with your employer, see if that's something that's offered, and get signed up for that right away. And there's, knowing what I know about childcare expenses, which is not a ton, but enough, that's not even a start, really, right? That $5,000, it's not like that's going to cover the year by any means. That's going to cover, a month or something maybe, depending on, again, your situation, where you live, all that stuff. But do that. Save yourself some money. Don't pay taxes on the first $5,000.
And I believe, because I know I talked to her about this, Travel Queen, she hasn't been on the show forever, but she was telling a story one time about how the daycare people think she's crazy because she gets these different cards and she has to hit a certain spending level. And so she tries to go ahead and prepay her daycare, and they look at her like she has 16 heads. That's kind of going back to what we were saying earlier. But what I don't remember her saying, I don't know if she's doing this or not. I would imagine if she had the ability to, that she would. She could probably go ahead then and turn around and immediately reimburse herself from this same type of account, just like you could do with an HSA. So even though you're fronting it, you're getting your points, you're traveling for free, you're saving money on taxes, you're reimbursing yourself through that account. You could potentially be doing all of that at the same time, just like the HSA strategy that we outlined earlier.
Right. And again, just, you know, encourage you to check into that. If you have a dependent and you're spending anything, right, for care for them, just really need to look at that, because if you're not utilizing it, essentially you're leaving some money on the table. I've yet to hear a case where it didn't make sense to do it. I can't really fathom one. So like you said, we don't give advice, but when I've heard any argument I've ever heard against it, basically boiled down to I don't fucking understand it. I don't know if I want to get into it. Whatever, as okay, yeah, I'll look. What it and it just doesn't make sense. Okay, well, you just like spending more money, I guess. I don't know what to tell you.
Yeah, and you should look at it to the listener, as part of your compensation. Same thing with your retirement, which we're not going to get into today. But all the different benefits that you have, there are people there in HR, your benefits office, or depending on the size of the company that you work for, there should be a lot of different online tools to help you with these sorts of things. And you should absolutely take advantage of it. And it's not like you're doing anything to anybody else's detriment or something you should feel bad about. These accounts exist for good reason because they're expected to be used. And it's just a shame when you have somebody that doesn't take advantage of this. And generally, those are the people that probably aren't making mega millions at their job, and they might be close to or at paycheck to paycheck, and those are the ones that need the tax savings and the relief and help the most. So don't be shy. Talk to your benefits folks. Talk to, if it's a smaller organization, even whoever does HR, the business owner, if you have to, whatever, to get a better understanding of how these things work, because you really should be utilizing them to the extent that you can. Okay.
Yeah. No, I mean, again, just we've talked today about some accounts that can help you with, again, two of the biggest expenses, right, that will drive for most people, right? Healthcare and childcare. And these are ways to help you get some of that paid tax-free.
Yep.
Not a lot of people, to your point, are in a position where they, should, would, or could, scoff at that, right? It's in essence, it's a little bit of free money to help what's already two very expensive, industries, childcare and healthcare, two very expensive items on your list to help make them a little less so. So use them. Like you said, you're not doing anything wrong or whatever. These were put there to benefit you. Take full advantage of it.
One more thing I want to say, and this will probably be close to the end for me, but something that I'm guilty of. So, we're here doing the show for education, entertainment. Hopefully you guys got something out of it. But I would venture to say, at least I know I'm not, and I Credit Union Cowboy probably say the same thing. We're not perfect, okay? And I'll give you an example. So I use an HSA. I max fund the HSA. We've talked about that. One thing that I've looked at for the past couple of years, and quite frankly, I haven't used because I'm like, it's not really enough to fucking worry about it, is the limited purpose flexible spending account, which because I have a health savings account, because I have an HSA, I can only use the limited purpose flexible spending account for dental and for vision. Well, I've had LASIK before. I get my annual checkup, which is typically covered by insurance, right? A lot of times I wear glasses for, nighttime driving. So occasionally I'll get some new glasses. When I go to the dentist, you would think I'm still a little kid because I always get the fucking fluoride for 20 or 30 bucks or whatever it is. And to me, those things, it's just not worth opening up another account to look at it. So normally I will reimburse anything I need to out of my HSA. But one thing I'm going to publicly admit here, I guess, on the podcast that I'm going to do starting with the next benefit year is take a serious look at the limited purpose flexible spending account, go back and look, okay, what do I know for sure? I know I'm going to get fluoride twice a year, and that's how much this costs. I know I'm probably going to get another pair of glasses and spend at least this much money. And I'm actually going to probably put a couple pennies or a couple $100 or whatever the hell it is into a limited purpose flexible spending account to preserve part of the value in the HSA. And I'm not trying to contradict what I said initially in the show about building it up to an astronomical amount, but those are some additional dollars or an extra couple $100 that could remain year over year over year in that account for other medical expenses. And so where none of us are perfect, I'm guilty too. we got to take, advantage of our benefits and whatnot. And that's one thing that I had been looking at, but I really didn't like the use it or lose it. And I know there's somebody that's going to write the show and say, well, wait a minute, you have a grace period of, I think it's 2.5 months after the plan year ends, or your employer could allow you to carry over a certain amount of money. I think it's $500 or $600 something bucks in 2023, depending on what they choose, if they choose to do that. And that's all fine. I just didn't want to put money into something that it was a negligible amount of money and it's something else I have to fuck with. But after talking to ourselves here for an hour on this show, or an hour plus on the show, I am, I guess, convincing myself publicly on the podcast that next year I probably will get and utilize a limited purpose flexible spending account for those vision and dental expenses, because I can't use it for medical if I'm still doing the HSA. So there's my cash flow king is not perfect. I suck just as much as you guys listening to this, and we're all going to change it together. There you go.
You guys don't suck that are listening to this.
Yeah,
unless
that's right.
You don't have a dependent care account and have dependents, in which case, But
all right,
no,
we just lost 2 subscribers. No, I'm kidding. Go ahead.
No, I mean, again, well, like you said, it's all about, going back to, our first convo when you first had me on, I think, right? It's about education. And so educating ourselves, right? I shared some personal stories, that I had and things that I didn't know had existed. If I'd had done a little more research, or, I don't know if they existed at the time or not, right? But I made some, less than great choices, right? And it wasn't on purpose, it was out of ignorance, right? So that's what we try to do here, is try to explain some things, again, give you the options. As always, do your own research, look into it, make the decisions that are right for you. Hey, if you've got an idea of why the dependent care is not good for you, write the show.
That's right.
I'd love to hear about it, right?
Real Talk Personal Finance at gmail.com.
Right. But it's, just trying to provide, again, different avenues, things that, folks may or may not be aware of or familiar with. It's daunting when you see stuff, when you hear stuff about, different options. I know you get the benefit packet to look at each year, and most folks, right, the way that they approach that is, how quickly can I sign up for the same thing I had last year? That's it, right? Situations change, benefits change, structures change, right? IRS regs change, everything changes. I know it's a little bit of work, just like we talked about with the car insurance thing, right, previously, where shop around a little bit. Maybe you don't do it every year, but on this stuff, you really ought to be looking at your situation annually when you go through that open enrollment period. And, hopefully we've given you a little bit more to think about in terms of some of these benefits. If you're already using a lot of them, terrific. Kudos.
Yep. I think I'm probably going to butcher this, but I want to say it was Maya Angelou. There's a quote out there: when you know better, you do better. Right. And so hopefully this show can be that segue for all of us, as we're learning and sharing and talking about different things. Maybe, hopefully, you guys learned something today that maybe you didn't know before, or something that you want to explore that you didn't explore before, or something that maybe you did know and you just weren't doing it. Now we're giving you a kick in the nuts.
These nuts. Got him. Got him.
Or whatever your private parts happen to be, to go do it. And, hopefully we can all grow together. So that's what I got for today.
Sounds good. Well, again, thanks for having me. Always fun being on with you. Thanks for the invite.
You're welcome. Thanks for being on the show. That was episode 42, Back to Basics, Intermediate Edition, Conversation with Credit Union Cowboy, Part 2. Hopefully you guys enjoyed it. Don't forget to check out, if you're interested in becoming a premium subscriber to the show for as little as $3 a month.
Premium.
Link is in the show description. We got some merch out for the show, so show your love for the show. Get yourself some merch. RTPF10 for 10% off merch. Premium subscribers, we'll send you a separate code for 25% off if you subscribe to the show. We got Cube Crusher working hard behind the scenes on the Q2E newsletter that's going to be coming out for premium subscribers. We'll probably do a premium-only episode for that, where we kind of talk through the newsletter and some things that are contained therein. We got Cashflow King's favorites, like I mentioned. We got a credit card out right now that we are kind of talking about as far as one of the favorites for the show, and the list goes on and on and on. So thanks again to let's go ahead and shout them out again. We did them at the beginning, and we're going to go ahead and do them here at the end. We got Craig M., Diane D., and Cameron C. Thanks again for subscribing to the show. That's it for episode 42. This is the Cashflow King with Credit Union Cowboy signing off. We will see you in the next episode.
Check the mic and make sure it sound right, boys.